We're going to start with open banking and a look at how tech companies and banks are interacting with each other in that space. And to kick off the first session, we're going to have a short spotlight on Ripple, the global settlement network. Now, Ripple is now working with over 30% of the top global banks, offering an impressive 33% reduction in operating costs for international payments. And here to tell us about the implications of open banking for international payments, please welcome to the stage the Managing Director for Europe of Ripple, Danny Aranda.
Is my mic working? Just doing a quick sound check here. Thumbs up? Great, thank you. So thank you for having us, Innovate Finance. We're really happy to be here. I'm Danny Aranda, MD for Europe at Ripple. I moved out to London about a year ago from a headquarters in San Francisco because a lot of the activity that we're seeing in the UK and in Europe in particular was really heating up, and we wanted to make sure that we're building an adequate second home here. The presentation I'm going to walk through just describes at a high level our view on the market and what we really see as the opportunity, both within the blockchain space but within the banking space more broadly. So I would say the first thing we want to focus on is, I think a lot of times when you think about blockchain, you think about technologies enabling new opportunities. But we want to maybe take the opposite approach to say that technologies are typically just the foundations to allow for certain things to happen, but that the driving force, the demand for those kinds of capabilities really need to come from the market. So what are we seeing in the market today in terms of new demands for types of transactions and types of financial services? If you look at the really fast-growing companies, the really fast-growing corporates, these are businesses that are relatively categorically different to businesses that exist before. So if you think about companies like Uber, Airbnb, Alibaba, Facebook, these are more platform companies. They bring together two sides of an equation in order to transact. And a lot of these companies were online from day one. They're global as well. So if you get an Airbnb house, you could be someone traveling from the UK over into Brazil. And they just have new kinds of needs, new kinds of demands. So a good example of that is someone like Uber. Uber needs to move $10 from a bank account in San Francisco over to the mobile phone account of a driver in India. And they want to be able to do that in real time or else they're going to lose that driver. That's a really different kind of need than, say, Shell has, or some of your more traditional corporations. And largely what we're seeing is this move from a world where it's acceptable to move large amounts of money in bulk, in batch processes, to a world where things need to be more on demand, more immediate, and actually need to support very, very small, tiny amounts moving around the world. So in terms of what we see as the problem today is that the current financial infrastructure for the way that we do transactions really wasn't built for these kinds of use cases. It was built for a more batch process world. And so what this has done is increase some of the costs around doing some of these lower value transactions. It introduces a lot of risk in terms of how it moves across multiple counterparties, and introduces delays as well. So your typical wire, say, takes a day to 3 days to actually settle. And I think what blockchain really inspired was a way to look at a more internet-style approach for the fundamentals of what happens in the infrastructure. And that's really exciting because if you think about fintech overall over the past 20 years, a lot of the focus has been at the application layers. So think about PayPal or Venmo or TransferWise. These are companies who produced a better product experience for doing certain kinds of things online, certain kinds of financial services. If you read PayPal's annual statements, the way that they articulate themselves is that they have taken the existing financial infrastructure and they make it work for a digital connected consumer. They're essentially simulating an online experience, what it would be like to transact, but still using the same pipes, the same plumbing underneath. And what blockchain really introduced was a new kind of plumbing. How can we actually connect different sources of value around the world? Our point of view, though, is that blockchain is ultimately just a new kind of database. It's a decentralized, distributed database. It works by some very transparent rules that can be open source. These are very interesting dynamics. But we don't think it's necessarily feasible to put the entire world on a single database. If you think about the internet, that's not the way the internet works. We don't access one database when we access the internet. That's a very kind of AOL-like view of the world. Rather, it's all about interoperability between systems, and this is what we're beginning to think about at Ripple in terms of thinking about what's next after blockchain. So if we think about different systems of value that allow us to move funds today, we largely view blockchain, Bitcoin, Ripple, Ethereum as being kind of one of these types of databases. And that really what we want to do is create open standards, use some of the cryptographic techniques inspired by blockchain to begin to connect these different systems and allow them to interoperate, allow for funds to move seamlessly across borders and across different national systems like FPS over into ACH in the US. There's also the question of cryptocurrency. Where does this really fit in? How does it really help this overall picture? And we actually think it has a very important role to play. That cryptocurrency would allow for liquidity to be managed in a more efficient way between these different systems. And we can begin to see some of the demands of these new corporates, the Airbnbs and the Uber that we were referencing earlier, be serviced in a more efficient way, where you can actually bring down settlement times. You can reduce the cost of liquidity to the point where it actually makes it economically viable to move $2 from a bank account in San Francisco to a mobile phone account over in India. So in terms of what we're trying to do with blockchain, we at Ripple are beginning with payments. We're specifically starting with cross-border payments. And one reason why we're doing this is, I would say the main one is that we feel like it solves a problem today. But two is payments are highly strategic. If you look at a lot of fintech companies, there's a reason that you see kind of an outsized focus on payments, and it's because payments is the connective tissue for a lot of financial services ecosystems. If you think about lending, security settlement, a lot of capital markets, a lot of these services are actually rendered via a payment. The actual execution of them happens in that payment. So if we feel that we've provided a good foundation on the payment side in terms of inter-networking between different systems and allowing value to flow, we feel like we've provided the good foundation for a lot of other next generation services to build new kinds of applications. So going back to that kind of PayPal example, if you change the underlying plumbing and pipes underneath an application like PayPal, that could create new kinds of applications, new kinds of PayPals that we currently can't imagine. So if you think about the internet itself, this kind of new data and information communication network, it's really hard at the beginning of the internet to imagine a company like Google or imagine a company like Facebook. And we think we're at a similar time right now around blockchain. If we can reimagine some of this plumbing, we're going to introduce all kinds of new applications that we're going to see as consumers, as businesses, that are going to change our lives just as much as the internet has. That's all. Thank you very much.
Danny, thank you very much indeed. Well, it's now my pleasure to welcome onto the stage the moderator for the next session. He and his panel are going to look at the impact of open banking on financial institutions and what that means for consumer services. He's a director of innovation at Consult and an internationally recognized thought leader in the digital money. Please welcome onto the stage Dave Birch.
Now, in this session, we're going to talk about open banking. Oh, that's me. I'm better at Twitter than some of the other people in here. That's what that says. We'll just go around and do it. I want to make one quick point before I dive into the fintech pit here, which is the people that we work for are by and large not the little fintech startups. So I have a great interest in fintech, but I have a mercenary interest in fintech from our clients' perspectives. And as you'll see, we work for the sort of larger players in this game. So what I'm interested in is what fintech can offer. You know, I'm a little bit skeptical of you can boo me off stage if you like, but fintech's going to overthrow the banks and whatever, and Bitcoin's going to get rid of the Bank of England and so on. I mean, you can just park that for the next hour or so because we're talking more realistically about how banks and fintechs can work together. And the mechanism for banks and fintechs working together is open banking. Now, because I come from the more tech end of the spectrum, so to many people in the room, open banking is just a sort of random waffle word. It doesn't really mean anything. It's like blockchain or cloud or something like that. But to me, open banking means something very specific, and that's all to do with APIs. Open banking as in, right, we're going to actually open up the banking infrastructure so fintechs and others can connect to it. So for me, open banking is a specific discussion about these APIs and what people are going to do with them once they're opened up. And I thought I know the regulations from that thing we used to do, what's it called? European Union. Those things don't apply to us for too much longer, but the European Directive on Management Consulting is still in force. So I'm afraid I have no choice but to present a 2x2 matrix to you. It's the law. There's nothing I can do about it. So I thought a useful way of structuring the discussion, rather than just talk about APIs in general, I think we need to sort of break it down a little bit. And I think hopefully you'll see this is a useful way of structuring it. So this is how we do it with our clients. So first of all, you need to think about there are going to be mandatory and non-mandatory APIs. So there's going to be APIs that the banks have to put into place. Well, when I say bank, I mean account servicing, payment services provider. So no, because the ASPSP can interface to the TTP through the AISP or PISP, RTS. You're not writing this down. You're never going to pass the test on this stuff. Look, okay, I'm going to say bank for shorthand, but we all know I really mean ASPSP. So there's mandatory and non-mandatory. So in other words, there's things that the banks are going to be made to do, right? And there are things that the banks might want to do in order to obtain some sort of positioning or competitive advantage in this space. There's mandatory and non-mandatory. And then I divided them into payment and non-payment as another way of thinking about this. And if you look at the way those things kind of map out, I mean, broadly speaking, you can see different kinds of competition and cooperation in each category. So the thing that most of us are really focused on right now because of PSD2 and the timescales, and I'm sure you've all read the regulatory technical standards about this, and we're all looking at the timescales. So we're very focused on that bottom left corner. But from a business point of view, it's not obvious how banks are going to make any money out of that. Because here you're talking about mandatory stuff, everybody has to implement it, transaction fees are asymptotic to zero if they're not zero already, and if you try to charge for anything this, people just go to somebody else straight away. So here's stuff we have to do, but it's not obvious how to make money out of it. Then we've got stuff that we don't have to do, but we might want to do anyway because we think that gives us an advantage. So if the bank has some special capabilities in I don't know, whatever it is banks do, trade finance, LIBOR fixing, whatever it is, we have an API for that sort of thing, and that's non-mandatory, right? But we might still want to do it. Maybe if we're good at something in that space, maybe we can charge for something there. Up the top, we have the non-payment APIs, which in the UK specifically is a slightly different from in other European countries. People are looking at the PSD2 AISP APIs, and those should be broadly congruent with the UK's special case, which is the Open Banking Working Group information APIs, which come out of a different. They come from the Competition and Markets Authority and the remedies and all those other things. But obviously it would be stupid to have two completely separate lots of APIs. So broadly speaking, we would imagine that the non-payment mandatory APIs would be roughly the same and they might well converge. Again, it's not obvious how to make a lot of money out of that because everybody will have to do it and they'll all do very similar things. And some of them are quite boring. So for example, if you go to GitHub and look at the APIs right now. It's best not to do that before bedtime, in my opinion. But if you go and have a quick glance through it, what you'll see is those kind of information APIs are, like ATM locators and stuff like that. I mean, how can you make a living out of this? I'm not sure, but the panel are going to tell us. And then in the top right-hand corner, you've got the non-mandatory, non-payment APIs. And this is where my biases are very clear, because I think personally, if the banks are going to make a living out of any of this stuff, then looking towards payments to do it probably isn't, a great idea. There's not a lot of money in that sort of thing. And it's cross-border, obviously, for people like Santander and so on. But like if the average bank, trying to make money out of this when everyone else is doing the same thing, hard. So we look towards the non-payment stuff. And because we want to differentiate and maybe do something either for banks individually, or I think more likely for banks forming their own platform, we probably want to look more into the non-mandatory, non-payment APIs. And there are a few different candidates for stuff in that area. Again, I tend to think, if you look statistically at the kind of work we're doing with clients, there are things like identification, authentication, authorization that are up in this corner, which it's more plausible that banks could form a differentiated service and make a bit of money in that space. So a couple of things I want you to take away from this. So first of all, because I come from the tech side, open banking isn't a waffle thing to me. It means something very specific about opening up these APIs and what's going to happen then. And secondly, it's not an undifferentiated mass of APIs. There's different ways of thinking about these APIs and grouping them. We're going to use that in some of the discussion.